There's an old joke, bankers never die, they just lose interest.
That's funny enough.
It's funny enough for a finance podcast, right? So interest rates, you've certainly paid them, but why did you pay the particular interest rate you had to pay? Who figures that out?
That calculation is really related to a lot of other stuff, to the inflation rate, for example.
To economic growth?
Maybe even to the employment rate.
I have no idea what we're talking about. If only there was a podcast that would explain these things.
Maybe we could do one. We work at a bank, after all.
What should we call it?
How about a dictionary of finance?
A dictionary of finance. That's brilliant. Let's do it. To talk about interest rates, inflation, growth, and employment, we're joined by Natacha Valla and Markus Berndt.
Markus is the head of the operational strategy and business development division of the European Investment Bank. When he was at the university, he played in a rock band and released 2 records. He says that unfortunately they never managed to become famous enough, which is why Markus then had to stick with economics.
Natacha Valla is the head of the Policy and Strategy Division in the Economics Department at the European Investment Bank, the area that Markus used to run, in fact. She studies investment dynamics and international capital flows.
We should have a whole podcast about investment dynamics and international capital flows.
We should. I guess the main purpose of these podcasts is to show how much we don't know about economics, so that our guests will return to do more podcasts out of pity for their poor, uninformed colleagues, Allar and Matt.
But let's start with the basic definition. So, Markus, can you tell us, what is inflation?
Okay, well, inflation conceptually is the difference of, or the development of, let me start another way. So if you have a basket of goods, so everything that a normal household is buying over the course of the year, if you take the prices of these goods, the total price that you would have to pay for this basket of goods, and compare the price you paid last year with the price you would have to pay for the exact same basket of goods 1 year later.
Okay.
That difference is the percentage change between price before and price now is the inflation.
This basket of goods is extremely interesting. For example, last year in the UK, I understand they removed from the basket things like CD-ROMs and nightclub tickets, and they included in the basket of goods coffee pods and women's leggings. So is this basket of goods, is this a constant thing across geographies, or is this does it depend on what people actually spend their money on in different countries, or how does it?
Well, I guess ideally it should be a reflection of what affects people's daily lives, and if CD-ROMs become less important, which is probably the case, less important than MP3 players, then you have to at some point adjust and put MP3 players in and take CD-ROMs out.
But why does it change at all? Why is there inflation? That basket of goods a year ago, why is it different today?
Well, there doesn't have to be inflation. It's not a natural phenomenon. It's actually in the, and I'm sure Natacha, who's worked at the central bank, unlike me, can add to that. But it is in the interest of the economy that there is some sort of inflation, because it supports the adjustments of relative prices in the economy. For example, if I have a certain job, I'm producing a certain good, or the company that I work for produces a certain good, the society starts putting less relative value to that good and is is actually valuing my work slightly less, or is less important to the economy. If I don't have inflation, then at some point I have to reduce my real wage, because I don't, in the distribution of wealth or the allocation of the benefits of what is being produced, I would actually receive a smaller share. So if there's and that is very hard to have a real nominal cut. Whereas it's easier if inflation is there, then all the prices increase, let's say by 2%. Most of the people's wages increase by 2%, but not mine, so I stay with the current one. But then in relative terms, my wage has been reduced compared to the others, which allows the adjustments to take place. So then later on, maybe I'm looking for a different job, or other people won't take the job again that I'm currently having. But in general, inflation helps these kind of adjustments to take place. And many other things that it helps, which I'm sure Natacha can add to.
No, maybe just to put some perspective on what Markus was saying, it's a matter of supply and demand. If you produce something, a good, and the supply of that good is big and the demand is small, then the price of it will have a tendency to fall because there's oversupply. On the contrary, when your demand for, say, you were speaking about CD-ROMs. Now we don't demand that many CD-ROMs anymore. So the prices of CD-ROMs, very likely for a given number of factories producing them, has been going down. So this is the reason why prices go up and prices go down. Now, over time, you can have a sequence of years where the economy is doing well. People have higher wages, they earn more, disposable income is higher. So prices will have a tendency to rise over a few years, and then the cycle turns around and we go to a downside of the economic cycle, and then that's when inflation tends to decrease. So we have over time, as a reflection of what Markus was saying, over time we have real waves of inflation going up and down as the economic cycle evolves. And in a sense, that is why most central banks in the world right now have taken inflation as a target for their policies, because they want to stabilize the economy.
But the goal is to avoid the waves, the cycles. The goal is to keep it steady, right? So the central bank says that they want inflation to be below 2%, but close to 2%. So that's the magic formula. Where does that come from?
You've learned the ECB formula very well. It's only the ECB who defines inflation in that very specific term, meaning close to but below 2%. Now, there are two goals, I would say, or even three goals now to target inflation. One, in the past, was to avoid hyperinflation, so to avoid from one year to the other prices to escalate so fast that people couldn't really keep up, wages were too slow to adjust, so the income was too low, and then it was really yielding to instability. So that was really the idea for central banks to start targeting inflation, was to avoid those episodes. Now, funny enough, and I'm sure Markus can say more about it, for about a decade now we've lived without inflation, with inflation being too low and even negative, which is something nobody ever thought of as realistic, at least for such a long period of time. So beyond what you were mentioning, which was correct, which was smoothing the economic cycle and have some stability, there's also the idea of avoiding extreme developments in inflation prices, either extremely high inflation rates or extremely low inflation rates. And that's the difficulty we have right now.
Yeah, maybe you want to, this is not just for the sake of having a nice inflation rate. The problem is if you have too high inflation, that means that the main purpose of money, which is to guard value, or to if you earn money, you want to have this money, and then whenever you want to spend it on something, you want to have this available. If you have hyperinflation, obviously that purpose is gone and it becomes useless, and then you rather hoard cigarettes or something else, or gold. And at the same time, deflation, so when prices are falling, leads to a different effect, which is negative, which is that nobody will consume anymore. So I will not buy, I will think about, I need a new chair in my kitchen, but I'm not sure if I buy a chair now, because maybe next year chairs are even cheaper, or next month. So then everybody will hold back their consumption. So that's why economists have, or there is kind of consensus among economists that some inflation is good, but it should be relatively low. It's not very clear. I remember that when I was at the IMF, we tried to figure out what is the perfect or the right level of inflation. It's for Europe, the ECB has decided it's 2%, but it could also be in other economies that it's 5 or 6. All we know is it's certainly higher than 0, and it is certainly lower than 20 or 50%.
So let's say the ECB, the European Central Bank, decides 2%. That's where we want inflation to be. How do they control it? What do they do?
Right. There's normal times and there's abnormal times as we have right now. Normally what the central bank thinking is based on is one thing, the evolution of money. So the central bank believes that there's a link between the quantity of money that circulates in the economy and the evolution of prices. What Markus was saying, when there's more and more money, so the ECB produces 100 billion, 200 billion, 1 trillion, 2 trillion, as it has been now with quantitative easing, the quantity of money has exploded in the economy for an economic activity, the potential for the economy that has not changed that much. So the unit value of those euros should have gone down. So in normal times, the more money you have in circulation, it's related to a higher inflation rate and vice versa. So by controlling the quantity of money is one thing. Now, modern central banks take another instrument to control inflation, which is the level of interest rates. I think we are going to discuss that.
So basically, by lowering the interest rates, they make it more appealing to spend that money.
Right.
Right. And so therefore prices should start rising.
That's exactly the mechanism. So the level of the interest rate is the opportunity cost of holding money, but it's also the price of credit. So the lower the interest rate, the higher investment will be. This is old Keynesian economics, but this is still holding in the thinking. So lowering the interest rate gives you more credit to the economy and more support to economic activity.
So you mentioned Keynesian economics. So that's from the 1930s,
right?
Let's say.
Already had the mechanism, right? I'm not saying Keynesian policies, but I'm saying Keynesian mechanism. So the link between the interest rates and investment dynamics and prices.
So basically the interest rate is the cost of getting money from a bank, and also the benefit you get from keeping your savings in a bank. Right? So it's basically the same. The rate refers to the same number or
right.
Same cost.
In practice, though, the interest rate that the central bank controls is more technical. It's the interest rate that banks are facing for their wholesale business. And there's a whole literature on the link between the money market interest rates, so those wholesale interest rates, the policy rate, which is the rate that the central bank actually controls. It's the price of the liquidity it puts on the market on the one hand, and on the other hand, the interest rates that prevail in the economy. The one the bank will quote you when you want to buy a house or when a firm wants to buy some equipment.
So there's a gap there. So when the central bank says that they will lower or raise the interest rates, that doesn't automatically translate into me getting a better percentage on my loan or getting a better savings account interest rate, right?
So here Markus will have examples from the bank, from the EIB, but this is called, what you described is called the transmission of monetary policy from wholesale interest rates to retail interest rates. And this transmission takes a while. It's not instantaneous, but there's indeed what we call a spread, a difference between market rates and retail interest rates. And the EIB is also having to work with that spread.
Yes. Well, that's precisely the problem. And but there's not much you can do about it. I mean, developing countries sometimes try to control the interest rate directly, like Ethiopia, and it always leads to a mismatch of demand and supply. So there's, at the end, the interest rate that you or I will face when we go to the bank trying to borrow something will not only depend on how cheap money is at that point of time for let's say the savings bank or wherever I go. It also depends on how risky the bank. The other main component is of course the riskiness that the bank puts into myself when I ask for a loan to buy a house, and that then again that does not only depend on my own how they judge myself as being risky, but also on how they see the market developing for house prices and all this. So at the end, as Natacha said, this is a very complicated and technical way trying to steer the economy and through this transmission mechanism in a way where you don't have much control, or much less than people sometimes think. So the only thing that the central bank can control is how cheap is it to get money from the central bank. It cannot directly control how cheap is it for banks to get money from someone else, or it certainly cannot control directly how cheap is it for a retail customer, for normal citizens like ourselves, to get money from the bank.
It would be a crime not to mention quantitative easing in this podcast, because that's the way the central bank nowadays really tries to influence inflation, really tries to influence economic activity. And in one word, quantitative easing is the ECB creating money and using that money to buy other assets. In those assets, most of those assets are government bonds, so bonds, debt instruments that sovereigns are issuing. But among those instruments in the euro area right now, the ECB also buys EIB bonds. So those instruments that the EIB issues on the market to have the funding to do exactly what Markus was saying, this quality control, allocating money. So in a sense, right now with QE, the two institutions work together, with the ECB issuing a lot of money to try and, impulse inflation and have a higher inflation rate.
So thanks to the quantitative easing, which you called QE for short, and thanks to the central bank buying EIB bonds, we actually make sure that this money reaches the real economy, right?
Absolutely, and not only reaches the real economy, but reaches in the best possible way according to our competences.
But so far, even through, there's this increased supply of money and low interest rates, they have still not translated into higher inflation. So why is that?
Well, first of all, I think inflation is picking up a little bit. So I think we are seeing some positive developments in the literal sense in terms of inflation, but we're not there yet. I think, and obviously, I mean, these are difficult times for economists because not everything is holding up all the time as we were hoping. But for the EU, it's investment decisions, as I said before, are not only depending on how cheap is it to get credit. And actually, I would think that's probably only the second or third thought. Mainly, investment decisions are about that you believe that it's worth spending money or investing money into something that will generate returns that justify that investment. And that, in return, depends very much on the confidence that you put into the market that you're trying to serve with whatever you want to produce with what you're investing. And unfortunately, after all these years of crisis, almost a decade now, the confidence is still rather low. I guess it's picking up. Natacha, maybe you know more from the investment service that you've done, but with confidence still being low, it's very difficult to. On the whole, there will be just less entrepreneurs who think, oh, it's worth investing in the European markets. For example, I think, if I'm not sure if the EU will be there, and I hope we all hope that the EU will be there, and we have to be careful in this podcast, I guess. But okay, if people have doubts about the existence of the EU or of the single market or the continuation of the continued deepening of the single European market, then you obviously think twice whether you invest into self-driving electric cars in Europe or whether you do it in a different market that's much bigger. Like they're much bigger economies. Like the US is bigger, China is bigger, India is bigger. So you wonder if many of these new investments and new innovations depend on scale. So it only makes sense to put a lot of things into a system for electric cars or charging stations or whatever it is, if you believe that there's a long and continuous and deepening single market. So as long as there are doubts about it, and we all hope that the doubts will be dispelled during the course of this year, but then you just think twice, and then it doesn't really matter if the money's cheap or not, or it matters less.
Well, we also wanted to talk about in this podcast, we also wanted to address a little bit what is employment and where does that figure into this. Now we've talked about Keynes and the ideas from, I suppose, the 30s. Some of us might have studied American history and Roosevelt creating jobs, essentially having people dig holes and so on in the road to create growth. At least that's the way, when I was 14, my teacher was talking about it. Probably it's an old theory now, perhaps, I don't know. But that was a focus on employment. Then we talked, Natacha, about, let's say, the monetarists saying it's more about how you control the money supply. And now it sounds like there's a mix of the two. Where does employment fit into the calculations of, let's say, the European Central Bank or other central banks at the moment? How important is it compared to controlling the money supply and so on?
So just a few words about employment. Employment is a concept that measures how active economies are. So what is the share of the working age population which is involved in the labor market, and on the share that is involved in the labor market, who is working and who is not working. So this is a sort of real measure of economic activity. Now, the link between...
So it's the goal of everything.
If maximizing employment may or may not be a goal, linking that back to central banks, the ECB has a single objective of price stability. The Federal Reserve in the US has a dual objective of inflation on the one hand and employment development on the other hand. So I'm quoting this because there is a link between the two, and there's a trade-off between the two. So you have inflation developments on the one hand, employment, unemployment developments on the other hand, and usually over history, we are mentioning, economic history. There's one economist called Phillips who invented something called the Phillips Curve, which basically says there's a trade-off between inflation and growth, or inflation and wage dynamics. How does that work? When economic activity improves, that's what I was saying about supply and demand, it puts pressure up on prices. So with improving economic dynamics, you have also inflation coming up. With decelerating economic dynamics, you have a deceleration of inflation. So that was the traditional relationship, and that's what the central bank was trying to play with between the two. Now, nowadays, there's a bit of a doubt about the shape of that relationship. At the times, I don't know exactly when Phillips was living, in the 70s, probably 60s. I should have looked it up. But there was a very nice downward sloping curve between the two. Now, people say, well, this curve might have shifted. This curve might have become flatter. And why do people say that? Exactly for what you were mentioning at the beginning. We have economic activity picking up, the recovery is there, but inflation is still very low relative to what we have seen in the past. So it might have been indeed that the curve was shifting as the recovery was picking up, so the level of inflation was like following the shift of the curve, or the curve has become flatter, so whatever happens on employment and growth dynamics, nothing happens on the side of inflation. This being said, as Markus was saying, inflation is in fact picking up. And I think we have moved over the phase which a few years ago some economists were saying, we live in a deflationary world, we will have deflation for a decade, it's like Japan for a few, for the whole world, and we will never be able to get out of it. Current circumstances seem to suggest that we still have very low inflation rates, but we might not be so trapped into a deflationary spiral.
But when you say economic activity has picked up, you mean there's more jobs, or you mean economic growth has picked up?
So that's a very good point, because for a fact, economic growth has picked up and almost everywhere in the world.
So what is economic growth first of all? How do we measure that?
How we measure economic growth? So there's growth is, Markus was explaining the growth of prices. Now, economic growth refers usually to the growth of economic activity. So there's a measure of what we all produce in 1 year, and it's called GDP, gross domestic product. So it's a sum of all the value added that is, created in all parts of the economy, in industries, services, net exports, all those components. Typically, it's a very simple way to look at it. Economic growth looks at what consumption does, investment does, government spending, and net exports.
So if I manage to start charging for my product twice as much, that means that adds to economic growth?
No. Yes and no.
It does add to the inflation, right?
Right. So that's where the distinction between nominal growth and real growth comes into play. And when we speak about economic growth, usually economists look at real economic growth. So they correct for what you exactly described as the evolution of prices without an increase in quantity. So real economic growth is the growth of the actual value added, the output that we produce.
So, just to get this straight. So if I produce something like phones, for example, how do I make the economy grow?
To produce more phones.
Yeah.
So it's not enough if you just charge more for the same amount of phones. The real growth is about how many more activity there is.
So that's a very good example. Okay. This year you produce one phone, $100 per phone. Next year, two options. You produce one phone, $200, or you produce two phones, $100 each. The nominal output is the same in both cases, but in the case where you have just doubled up the price of your phone, real economic growth will be 0, and inflation will be 100. So that's exactly where we need to be very careful to measure real growth and not nominal growth.
And when we're talking about real here, that's popping out to me because we sometimes hear people talk about real interest rates as well. What's real interest rates?
Oh, real interest rates. Okay, that's yet another adjustment. Is how much do you say if I lend you money, right? I lend you 100 euros.
Please do.
And I ask you that next year you give me back 104 euros back, right? Then the nominal interest rate is 4%. You have to pay me 4% more than I gave you. But if at the same time the inflation was 2%, then the pain of you paying me 104 is less because the 104 isn't worth 104 anymore. It's worth less because even normally the 100, what you could buy with 100 euros before, now you have to pay 102 euros next year because of the inflation. So that the difference between the nominal interest rate minus the inflation is then the real interest rate. So the real interest rate in this case is about 2. I guess there's a slight adjustment, but it's about 2% because the other 2 you would have lost in any case by just keeping the money.
Are there any other reals that we should be mentioning here? We've had real interest rate, real growth.
That's the main.
That's the reality.
But to add perhaps to this real concept, there's the real interest rate and there's the equilibrium or natural interest rate, which is yet another sophistication that economists are adding up to the concept.
Wow, it's just getting way over my head right now.
You're slipping down in your chair, I can see.
Yeah.
So let's stick with the real rate.
Let's stick with the real ones.
Yeah, so we've got the real ones, and sometime soon we'll do a podcast about, what was the other one?
Natural.
All right, I'll write that down. Natural, I like that. We'll do it sometime after we do something on green investment or something. Natacha and Markus, thank you so much.
Thank you.
You're welcome. Thanks.
This was a dictionary of finance from the European Investment Bank, the EU bank. Subscribe to this podcast on iTunes and other podcast platforms, and we'll see you next time on A Dictionary of Finance.